Hello guys, and welcome to another video with Nadal Rashid. And in today's video I want to show you a positive cash flow property opportunity. Now this video is specifically around positive cash flow properties. This is not for people who are looking for a high growth property. It's not for people who are looking at investing in blue chip properties. It's not for people who are looking for development opportunities or renovation projects or anything like that. It's purely as an entry-level property for someone who's got limited money, limited income, limited resources, but would still like to take advantage of some investment opportunities out there. Now, the property that we're going to be discussing is actually a house and land package. It's actually a townhouse, but done as a two-part contract where the land is sold and then there's a building contract in place. This total package price is actually $244,900. So for under $245,000, we're talking about a fixed price turnkey townhouse. It is a 3-bedroom, it is 2 bathrooms, and it's got a double carport as well. So I'll show you the floor plan quickly and then I'll jump into the numbers. So the floor plan is very basic. Basically, it's 2 levels. Downstairs, you got the entry from the front, and there's a stairs to the side, which obviously goes over the toilet and laundry section. But then you're literally walking into a living, dining, and kitchen area. So this whole section downstairs is all the living space, and that is basically your dining, kitchen, family, all as one big open plan. There are double doors at the back which leads out into the little courtyard, and that little courtyard also opens up onto a double carport, and that double carport can be used to house either 2 vehicles, or in many cases a lot of people tend to use their carports for outdoor entertaining if they've got some people over. Now upstairs, as you come up the stairs, you've got 3 bedrooms. Bedroom 1 has got access to the bathroom, so it is a 2-way bathroom. As you can see, there's a cavity door there which leads into what could be used as an ensuite. Otherwise, it's got another door from the corridor which also makes it accessible for bedrooms 2 and 3. They've also got built-in robes. It is all turnkey, meaning that this house does not need anything else to be completed. That includes all the driveways, the landscaping, the fencing, the everything that's included, that's needed in order to be able to move in and start living there, or get the key from the builder and give it straight to a tenant. So $244,900. In terms of where Peachy Road is in Smithfield, so it is right behind Manapara. I mean, it's not an area that we would be investing in for capital growth such, but definitely as an investment for positive cash flow. Now, when I run through the numbers, I'll go through that really quickly. Basically, at $245,000, in terms of our due diligence costs, I've allowed $350 for a building inspection as per normal. In terms of our settlement costs, I've actually done this with a 10% deposit. So I've assumed that this is going to be for someone who's looking at a low deposit, a low entry into the property investment space. So 10% deposit is going to be about $24,500. Now the stamp duty, the best part about this is it's actually worked out only on the land component. Now because the land is quite cheap, the stamp duty portion is only $1,780, so less than $2,000 on stamp duty. And I've allowed $1,000 for legal fees, which is probably a little bit of an overkill. It's usually between $500 to $800, but I've allowed $1,000 nonetheless. In terms of the loan setup costs, I've allowed $400 to set up the loan. And because we're borrowing more than 80%, so it's less than a 20% deposit, I've also allowed just under $3,000 for LMI. So if you were to work out all of your purchase costs, if you add everything up together, it comes to less than $30,000. If you were to look at just your settlement costs, it's about $27,000. So definitely much more achievable for either the first home buyers, and if you're a first home buyer, obviously half of that is going to be subsidized by the first homeowners grant. So $15,000 is going to come from the first homeowners grant. If it's a home start loan, you can definitely do this with a low deposit option as well. Now, in terms of improvement and selling costs, I won't go through this today, but there's no improvements to be done. It's a brand new property, and selling costs is only if you sell, and I've allowed 2% commission, but that's not really going to come up in today's example. Now, as an investor, if you were to rent this out, I just did a quick search on realestate.com to see what similar properties are renting for, and they're renting between 300 to 320 per week. Especially if it's a brand new townhouse, you'll be looking in that 320 range. If it's something that's established and a little bit older, you're looking at around that 300 mark. So I've allowed $310 in rent per week, and I've also allowed 2 weeks vacancy every year. So we're assuming that there's going to be no tenants 2 weeks of the year, each and every year. Now, in terms of the property expenses, so these are the ongoing expenses. I've probably overloaded these a little bit. I've allowed $900 for rates, but obviously on land value cheaper than that, we shouldn't be hitting that much per year. Building insurance, again, $600 a year is what you'd expect to pay on about a $400,000 property. But in this case, I've just allowed that in there. There's no body corporate, there's no repairs or maintenance or cleaning contracts or service contracts or garden and lawn maintenance. There is obviously going to be a reletting fee every year. So every year you'll have a 1 week's rent that will be payable to your property manager. And I've also allowed 8% for a property management fee. Now, in terms of the loan structure, I have put this on interest only, obviously just to show the raw figures. If you'd like a principal and interest, let me know and I'll flick one through to you. That's no problem. The loan term, I've done it as a 30-year loan, which is a standard. I'm assuming a 10% deposit, which is a 90% lend, which gives us $220,000 being borrowed. And the interest rate, I've worked on 3.5% because I'm assuming there's going to be some first home buyers who this property is going to appeal to. Obviously, rates at the moment are in the, I've seen them in the high 2s, low 3s. So I've allowed 3.5 just to be on the safer side. Definitely gives us a bit of a buffer anyway. So which obviously gives us a range of options that we can go to. In terms of tax and market factors, now because this is a brand new property, we do have depreciation benefits that are available in that property. So I've allowed those depreciation amounts on a sliding scale, meaning we get the bulk of the depreciation up front, and then it bottoms out at a certain amount later on down the track. Now, for capital growth and CPI, basically I've kept them in line with each other. So the CPI is obviously cost of living is going to go up by 3% per year, and capital growth, I've also just left that in line with CPI. So really, we're not expecting huge capital growth in the area. It's not an area that we would generally recommend for capital growth anyway, but definitely as a cash flow property, we have no problem in recommending something that's at that price point. Now, in terms of the taxable income, this assumes your position. So again, I'm assuming as someone who is not earning six figures, someone who might be in their first 1, 2, 3 jobs basically, and they're earning an average wage of $80,000. I've allowed the 32.5% tax bracket for this example. Now, if we jump into the scenario reports, this is what it looks like. Basically, a $245,000 property over a 10-year period doesn't get anywhere near doubling. So usually you'd expect a property to double every 7 to 10 years. There's a lot of guys out there that pitch that message all the time. I don't quite buy into that because I think you need to be realistic in terms of where you're investing. But certainly in this case, I've allowed 3%, which is just in line with CPI. That over a 10-year period means the property is going to go from 245 to say 330, which gives us about $85,000 worth of growth over a 10-year period. If you average that out, that's about $8,500 a year that you're adding in capital growth. So not a huge figure, but $8,500 is still a lot of money. Now, in terms of the interest, the loan amount, as you can see, because I've put it as interest only, the loan stays the same the whole way through at $220,000. However, as the value increases, you'll be freeing up a little bit of equity to then be able to either refinance or purchase again, or whatever your situation allows you to. But we won't go into that in too much detail in this video. The third section down, which is the rental income, so basing it on $310 per week with a 2 weeks of vacancy every year, that's going to give us a gross yield of 6.3% and a net yield of 5.1%. So that's after costs. Now, in terms of the expenses, the interest on that loan is going to cost $7,700 a year, and the property expenses are going to cost about $3,000 a year. So all in all, we've got about $10,700 going out, and we've got $15,500 coming in. So even before tax, this property is going to be positively cash flowed by $4,733 per year, or if we work it out weekly, that's $91 per week. So basically what we're focusing on is how do you make that extra $100 a week, from an investment property that just does its thing, it grows it in value, and it gives you some tax savings. Now, the tax savings is where it comes into. You see, if you bought an older property for $245,000 and you rented it out for $310 per week, that money that you made there, that $4,700, you'd actually get taxed on that. So they would add that on top of your taxable income, and out of that you'd have to pay, let's say, approximately 30% of that to the taxman. So you'd get $1,200 out, so you'd end up with $3,500 in your pocket as a net cash flow after tax. However, because we've got depreciation benefits, we actually get to claim $9,000 in this example in the first year. However, we've made a profit of $4,700, so we don't get to claim the full $9,000. We obviously offset that out of the $9,000, but we're still left with $4,903 worth of tax deductions. So that $4,900 is in deductions is going to give us another $1,594 back. So that $1,594 plus the $4,733 that we made before tax now means this property is positive cash flow by $6,327 per year, or $122 a week. Now that $6,300, you could be putting that back into your loan. You could be putting it back into your own home. You could be, saving that up and using it for further investing. You can keep it in an offset account and just let that offset some of the interest and wait for another opportunity to come up. Basically, starts giving you more options. But regardless, you're going to be making, at least $120 per week moving forward, whether you get up out of bed or not, whether you decide to work more hours or not, whether you decide to put more effort into your business or not. So this is why I love property, because it does give you the ability to make a passive income. It does give you the ability to get some capital growth along the way. Admittedly not a huge amount in this example, but you're still getting $8,500 on average, plus the $6,000. That's an additional $14,500 you're adding to your bottom line each year. And you'll save yourself a little bit of tax, so you'll get some of that back. So hopefully this example made sense. As always, if you have any questions, queries, or anything like that, feel free to shoot me a message or reach out. I'd be more than happy to help. And until next time, have a great day, and we'll touch base soon.